Welcome to the Pro Ticker Deep Dive. Today, we're really digging into a major shift happening in North American finance. We're looking at that big pivot everyone's talking about, the expected gradual decline in short-term interest rates. And our mission, looking at all this analyst research piled up here, is to quickly figure out two key things. First, which companies, which sectors are perfectly set up to thrive as money gets cheaper. And second, who's going to run into some new headwinds because of this?
Yeah, and what's interesting is the consensus on the path forward seems pretty clear, which makes this actionable for listeners, I think. The core forecast basically anticipates a gradual, quite measured decline. We're talking about 100 basis points off short-end rates. That should take us down towards, say, 3.5% by early 2026. And look, this isn't a panic move, right? The Fed seems focused on supporting growth, but they're definitely keeping a close eye on inflation risks. It's easing, sure, but it's cautious, very cautious.
Right, cautious easing. And that caution, well, it might actually present a huge historical opportunity, because if you look back at past easing cycles, specifically the ones that didn't immediately lead into a recession, the S&P 500, on average, posted a massive gain, like 26.5% in the second year of cuts. We've already seen pretty strong momentum in the first year, haven't we? Boosted quite a bit by the whole AI theme.
Definitely above average, yeah.
But now it feels like the focus is really shifting squarely onto these rate dynamics, which means the playbook for market leadership is probably about to change.
Yeah.
So, okay, let's unpack the mechanics a bit. How does this cheaper money actually translate into better earnings and higher stock prices?
Right, it works through two main channels, really. You've got the direct channel and the indirect one. The direct channel, that's the most straightforward. Lower interest expenses. This is a big immediate win, especially for companies holding a lot of floating rate debt, variable rate stuff.
Okay. The variable rate debt.
Exactly. They get instant relief on their payments, frees up cash flow, makes refinancing down the line way cheaper too.
Makes sense. And the indirect channel.
That's more about the broader economy. Cheaper debt tends to lift consumer spending. It also encourages businesses to, invest more bank capex, R&D. Plus, it just generally lowers the cost for companies to do things like M&A or share buybacks. So you see more activity there.
Okay, so you've got these two channels. Which one are the analysts betting on right now as maybe the faster or more immediate driver? Is it the debt savings or the spending lift?
I think the consensus is definitely on the immediate debt savings. That's the surest, quickest catalyst. And that leads us straight to figuring out, what a winner looks like in this environment. Based on this research, digging through all these stocks, analysts kept coming back to three key things.
Three criteria.
Yep. First, high variable or floating debt. Got to capture those direct savings we talked about. Second, they need to be leveraged to cyclical demand and capex. So companies that benefit when people or businesses start spending more again.
Got it. Cyclical leverage.
And third, often these winners have kind of depressed valuations right now, maybe strong dividend yields. That just means there's more room for the stock price to re-rate higher as things improve.
That framework makes a lot of sense. But here's where I thought the analysis got really interesting. Scale. It seems like size really matters when it comes to debt structure. Tell us about that contrast you found between the S&P 500 giants and the S&P 600 small caps.
Oh, it's a stark difference. It really is. If you look at the S&P 500, the big guys, they're overwhelmingly locked into fixed rates. Like 92% of their debt is fixed. And the average maturity, it's long. 11.4 years.
Wow, 11.4 years. So they're pretty insulated then.
Very insulated, yeah. For better or worse, short-term rate moves don't hit them directly very quickly. But now, flip over to the S&P 600, small caps. The picture totally changes. Only 56% of their debt is fixed rate. And the average maturity is much, much shorter, just 5.7 years.
5.7 years. Okay, so that shorter maturity, which probably hurt them when rates were going up.
Exactly. It was painful then. But now, it's potentially a huge advantage.
So hang on. If nearly half their debt is floating, you said around 41% for the S&P 600?
Roughly, yeah. About 41% exposure to floating rates.
Then this rate pivot isn't just a minor benefit for small caps. It could be like a game changer for their earnings.
That's precisely the key insight here. That 41% floating rate exposure means small caps stand to benefit much more directly, much faster, from rate cuts than the large caps. Size itself, right now, becomes a really strong indicator of rate sensitivity.
Okay, fascinating. Let's dive into those sectors then, the ones that fit this profile. Starting with consumer and leisure, where you've got that mix of demand sensitivity and maybe that helpful debt structure. Like, take autos. It's simple math for the buyer, right? Rates
Yeah.
drop 100 basis points.
Okay.
Analysts figure that shaves about $21 off a typical monthly car payment.
Instantly more affordable.
Right. Improves affordability, boosts sales. That's a direct line to benefiting automakers like, say, GM and Ford.
And you see similar dynamics in more specialized areas too, like RVs, Camping World, CWH. They get a double whammy benefit. Their inventory financing, they call it floor plan interest expense that drops immediately, could boost their EBITDA by maybe 5%, the research suggests.
Just from that.
Yeah,
Holy.
just from that. And then RV loans themselves can be really long-term, like 15 years
Yeah.
sometimes.
Oh, right.
So they're incredibly sensitive to any drop in longer-term rates as well.
Okay, moving to industries known for high leverage. Gaming, cruise lines. These guys must be feeling pretty good about potentially lower rates. It's almost like a balance sheet subsidy for them now.
That's a good way to put it, yeah. Companies like Caesars, CZR, they've got around 45% variable debt, and Penn and Entertainment, even more exposed, maybe 65, 70% variable.
Oof, that's high.
It is. So they're flagged as being really well positioned for immediate, significant relief on their debt payments. And for the cruise lines, Carnival, CCL, Norwegian, NCLH, it's not just about saving money day to day. Lower rates open up opportunities for them to refinance, restructure their balance sheets in ways that are actually accretive, improve their long-term financial health.
Okay, so that covers the consumer side, immediate savings, affordability. But what about the sort of physical economy, industrials, construction? Is the thesis similar there?
It's still definitely about investment, but maybe tilted more toward that longer-term rate-sensitive demand. Think affordability for big projects, capital spending. For construction materials, for example, lower rates eventually help with home price affordability.
Eventually being the key word.
Yeah, eventually. We probably won't see a big surge in residential demand until, say, the second half of 2026 at the earliest, according to this analysis. But companies need to be positioned. CRH plc is mentioned for its high residential exposure. And then AMRISE, AMRZ, is interesting because it leans more non-residential, plus it has good geographic exposure. Think Sunbelt states, faster growth areas.
Right. And machinery, rentals.
Names like Caterpillar, CAT, and United Rentals URI come up. The thinking there is that their long-term tailwinds, big construction projects, infrastructure spending, get amplified when cheaper capital makes those massive projects easier to greenlight.
Okay, next up, tech and clean energy. Now, for these sectors, especially the growthier ones, it feels like the benefit isn't just about lower debt payments, is it? It seems more fundamental. Valuation, capital intensity.
Exactly. You nailed it. Clean energy is hugely capital intensive. So companies like Sunrun, RUN, HA Sustainable Infrastructure, HASI, Brookfield Renewable, BEP, they benefit big time, and on two fronts. First, lower rates just make financing new projects cheaper. That's huge for development.
Makes sense.
Second, and this is the valuation kicker, lower rates increase the present value of their existing long-term contracts, like power purchase agreements.
Ah, the discount rate effect.
Precisely. The discount rate used to value those future cash flows goes down, so the value today goes up.
Yeah.
It's a powerful double benefit.
Very powerful. Okay, and what about pure internet plays, fintech?
Well, the big internet names, Amazon, Alphabet, Meta, they benefit indirectly, right? Improved consumer spending helps e-commerce, better corporate budgets help advertising.
Sure, the rising tide effect.
Yeah, kind of. But the real leverage seems to be in fintech. Companies like Upstart, UPST, SoFi, they benefit because lower rates actually increase demand from loan buyers for the kinds of higher-yielding loans they facilitate. Plus, their own funding costs, which are often floating rate, also drop. That improves their margins, their ability to sell those loans profitably.
Right, makes their whole model work better. Okay, we've covered the potential winners. Now we absolutely have to pivot the flip side, the headwinds. Identifying who might underperform is just as critical. So what's the profile of a company that might struggle, relatively speaking?
It's basically the inverse of the winners we just discussed. You're looking for companies with asset-sensitive business models.
Meaning their revenues are tied to rates going down?
Exactly. Or companies that are mostly locked into fixed-rate debt so they don't get the savings benefit.
Yeah.
And maybe they just don't have much exposure to the parts of the economy that get a boost from lower rates. Financials need a really close look here. It's kind of counterintuitive within banking.
Oh, how so?
Well, the winners, perhaps surprisingly, are regional banks that currently have high costs on their interest-bearing deposits. Think Valley National, VLY, Western Alliance, WUL.
High costs are good now.
Because they have the most room to cut those funding costs as the Fed eases. That directly helps their net interest income, their NII.
Ah, okay. So they have the most potential for margin improvement on the funding side.
Exactly. Conversely, banks that already boast very low deposit costs, like First Hawaiian, FHB, they just have less benefit to gain on that side. They could face pressure.
And you mentioned asset-sensitive models.
Right. That hits specialized lenders like business development companies, BDCs, names like Whitehorse Finance, WHF, Carlyle Secured Lending, CGBD. They face pretty immediate earnings headwinds. Their investment portfolios are often directly tied to floating rates, so as rates fall, the yield they earn on their loans drops almost instantly.
Ouch. Okay, what about the classic defensive plays? Utilities, bond proxies, how do they fare? They usually like lower rates, don't they?
Usually, yes, but context matters. In an easing cycle that happens without a recession where growth is still decent elsewhere, these defensive names can actually underperform. Money flows towards growth.
Right, the opportunity cost.
Exactly. And sometimes there are even specific mechanical disadvantages.
Hmm.
Consolidated Edison, ED, was cited as an example. Apparently, they see less benefit from falling rates in terms of interest expense savings because they don't carry any holding company debt.
Holdco debt.
Holdco debt.
Yeah, basically large internal loans at the parent company level that some other utilities might have. Con Ed doesn't have that structure, so they can't quickly refinance big chunks of debt centrally like some peers might. It limits the boost to their earnings per share, or EPS, compared to others with more flexible debt stacks.
Interesting detail. Okay, finally, there were a couple of really specific, almost niche headwinds flagged in the research. Let's start with agriculture. Archer Daniels Midland, ADM. What's the potential issue there? Seems very specific.
It is fascinating, isn't it? For ADM, the potential pressure is on operating profit in their ag services unit. Basically, when the cost of money goes down, the cost of carrying working capital for commodities also goes down.
And that lower carrying cost could, paradoxically, lead to lower markups when they distribute those commodities.
Yeah.
Cheaper money might actually squeeze their transaction margins a bit.
Wow. Okay, that's a subtle effect.
Yeah.
And the last one, health tech. Specifically health equity, HQY.
Yeah, HQY faces a very direct, very immediate revenue risk. Something like 45% of their revenue comes from custodial fees. And those fees are tied directly to the interest rates earned on the assets in health savings accounts, HSAs.
Ah, so as rates fall.
As rates fall, the yield on those HSA assets falls, and boom, their fee revenue gets compressed right away.
Got it. Direct hit.
So, look, if we had to boil this whole deep dive down to maybe two core takeaways for you, the listener,
Yeah.
it'd be these. First, you've got to relentlessly analyze a company's debt. How much is floating versus fixed? That's crucial right now. And second, really assess its direct sensitivity to cyclical demand. Is it consumer spending, like cars or cruises? Is it business spending, capex for machinery, construction?
Debt structure and cyclical sensitivity.
Understanding those two things is probably the key to positioning yourself successfully as rates potentially fall.
Absolutely. That makes perfect sense. And, just circling back to the start, while these rate cuts are meant to stimulate things, lift the market overall. Remember that historical pattern we mentioned? The S&P 500 performance tends to be way stronger in the second year of easing.
Right, the follow-through year.
Exactly. We had AI driving this first phase, it seems. So the provocative thought I'd leave you with is this. Assuming we manage to avoid a major recession, what's the next big theme? What's the catalyst that really drives that next phase of appreciation? Is it going to be a huge wave of industrial investment finally kicking in? Or maybe the consumer taps into their savings and propels growth? That's something to really mull over. See you all in the next Pro Ticker Deep Dive.